normally effort equals outcome, right? Like you
Yeah.
study medicine, you put in those grueling hours during residency, and bam, you become a competent doctor.
Right. It makes sense.
Yeah, exactly. That makes sense. You apply your intelligence to engineering, you build a stable bridge. The results reflect your brain power. But, and this is a big but, when you step into the world of day trading, that linear logic just completely fractures.
Oh, it shatters entirely.
Right. So today, we're doing a deep dive into this massive stack of sources we have. Algorithmic trading manuals, order flow theory, and these really mind-blowing neurobiology studies out of Caltech. And our mission today is to figure out why society's smartest, most accomplished people, the surgeons, the attorneys, the CEOs.
The people who usually win at everything.
Yes. Why they are consistently the absolute worst day traders.
It really is the ultimate biological paradox, because when these high-achieving professionals enter the markets, the very cognitive traits that made them so successful in their careers, they literally work against them.
Which is wild.
It is. So today, we're going to examine the actual mechanics of the market, look at some actionable trading setups, and unpack the hidden neurobiology that, separates the consistent winners from those who inevitably just blow up their accounts.
Okay, but before we can even talk about winning trades or the psychology behind them, we have to establish what we're actually looking at. Because the sources make it super clear, traditional stock charts are practically useless.
Oh, yeah. They're incredibly misleading.
Yeah, they're like looking at the final score of a baseball game, right?
Yeah.
You know who won, but it doesn't give you any predictive value at all. Order flow, on the other hand, is like having the pitch-by-pitch telemetry.
Exactly.
You know the exact spin rate, you can see the pitcher's fatigue setting.
You know when they're about to crack.
Right. I was looking at traditional volume charts in the sources, and it just felt so hollow. It's like, okay, let's explain this so a 5-year-old could get it. Traditional volume is like knowing 100 people walked into a toy store today.
Right, which sounds like great data.
Right, but you have no idea if they bought anything, or if they just browse the aisles and use the bathroom. Order flow seems to fix that entirely.
You own that analogy perfectly, actually. Order flow is like having the security camera footage inside the toy store. It tells you that 80 of those people sprinted through the doors, aggressively grabbing specific toys off the shelves at full price, while the other 20 people just stood around near the clearance bin, waiting for a discount. It gives you the why behind the price movement. And to see this, professional traders use two main tools. There's the tape, which is also known as time and sales, and the DOM, D-O-M, which stands for depth of market.
Okay, so for anyone listening who's trying to visualize this, the sources describe the DOM as like a vertical ladder of prices on your screen. The ask is what sellers are demanding, right?
Yeah.
Sitting on one side of the ladder.
Yeah.
And the bid is what buyers are offering on the other side. So these are the passive players, right?
Yeah.
The clearance bin people standing around waiting.
Exactly. Those are the passive limit orders. And then the tape shows you the actual transactions, the aggressors. So when an aggressive buyer comes in and just smashes that ask price, they're executing a market order. They're saying, I want this asset right now. I don't care about the price.
And they're sprinting down the aisle.
Right. And this brings us to the core metric of order flow, which is delta. So delta is, it's just the net difference between aggressive buying volume and aggressive selling volume.
Okay, so if someone buys 100 shares at the ask and someone sells 50 shares at the bid.
Your delta is positive 50.
Got it. So the aggressive buyers are overwhelming the sellers.
Precisely. You're watching the literal physics of supply and demand play out in real time. It exposes trapped traders and, hidden intentions way before the price even registers a single change on a traditional chart.
Which is incredibly powerful. But if you're actually sitting at your computer trying to trade this, knowing the theory isn't enough, right? You need to know exactly what a trap looks like on the screen.
Oh, absolutely.
So let's walk through a real setup from the sources. Say you're watching the tape. The price is pushing up toward a key level, say, I don't know, $50. Delta is highly positive. Buyers are aggressive, but the price suddenly just stops moving.
Okay, so you've just identified what the order flow manuals call absorption. This is the brick wall.
The brick wall.
Yeah. You have massive aggressive buying, just huge volume hitting the ask, but the price refuses to tick higher. And the reason for that is there's a massive hidden limit order sitting on the ask. A large institution, or like a big block of passive sellers, is just quietly absorbing every single buy order.
So the aggressive buyers, they think they're driving the price up, but they're actually just they're just exhausting all their capital into this invisible wall.
Yes, exactly. And when you see this massive aggression at a key resistance level failing to move the price, the actionable instruction here is prepare for a reversal.
Because they're going to run out of steam.
Right. Those aggressive buyers are going to run out of ammunition. They'll suddenly realize they're trapped. And then what do? They panic sell to get out.
And the price snaps back the other way.
Exactly.
Wow. Okay, that makes total sense. But how do you know when the pressure is actually building to break through a level rather than just getting absorbed? Because, I mean, clearly breakouts do happen, right? Stocks go up.
They do, yeah. And that's where you look for something called stacked imbalances. So if you're watching the order book and you see 3, 4, maybe 5 consecutive price levels where 70 to 80% of the volume is heavily hitting the ask side, the dynamic completely shifts.
Oh, so it's not just one level anymore.
Right. It's no longer just absorption at one spot. It's sustained, overwhelming force across multiple levels.
It's like watching all the weight shift to one side of a boat.
Yeah.
The sheer volume is just tipping the scales.
That's a great way to put it. It signals immense compounding pressure. So the instruction here is, when you spot multiple consecutive price levels with heavily skewed volume, expect the price to follow that direction rapidly. It's a real actionable forecast.
Okay, but what about the fake out? Yeah. Because the sources spend a lot of time on this, and anyone who's ever traded has felt this pain. You see stock break through resistance to a new high, you buy it, and literally 2 seconds later it crashes.
The dreaded liquidity trap.
Right.
Yeah.
But if the price goes up, shouldn't that mean the buyers are in control? Like, why does that happen?
Well, not necessarily. And this is exactly where traditional charts just lie to you. The golden rule in order flow is that a true breakout must be validated by strong positive delta. If the price pushes to a new high, but your order flow shows weak or even negative delta,
meaning the aggressive volume is actually selling.
Yes. If you see that, it is a trap. Do not buy it.
But fundamentally, why would the price go up if the aggressive volume is selling? That feels counterintuitive.
It does, but it comes down to liquidity hunting by the really large institutions. Think about it. If an institution needs to sell 1 million shares, right? If they just hit the bid, they'd eat through every level of the DOM and crash the price against themselves.
They'd get terrible fills.
Exactly. They need massive counterparties to buy those shares from them. So what do? They engineer a fake breakout. They use a relatively small amount of capital to push the price just above a known resistance level.
Oh, because they know all the retail traders put their automatic stop losses and buy orders right above that exact line.
You got it. The price crosses the line, triggering this massive flood of automatic retail buy orders. Suddenly, there's this huge pool of liquidity, and the institution uses that engineered buying frenzy to just dump their 1 million shares.
Wow.
That's why the price goes up, but the delta goes violently negative. The aggressive selling is institutional distribution. If you see price rise but delta fall, run the other way.
Okay, so the mechanics are actually quite logical when you lay them out. Look for absorption to spot reversals, follow stacked imbalances for momentum, and always validate breakouts with delta to avoid those liquidity traps. The rules are clear.
Very clear.
Which brings us back to the original paradox.
Yeah.
If the instructions are this mechanical, why do the doctors and the engineers fail so spectacularly?
Because, simply put, knowing the setup is utterly useless if your biology actively sabotages your execution.
Right.
The sources dive into this incredible neuroeconomics research from Caltech that explains exactly why this happens. They actually put traders in fMRI machines and subjected them to speculative market bubbles.
Okay, wait, I have to push back here for a second. How can an fMRI study at Caltech accurately simulate the real, actual terror of losing your life savings? Like, a lab setting is completely sterile. Sitting in a tube clicking a button just isn't the same as watching a real account train.
And that is exactly what the researchers worried about, which is why they didn't just use a simulation. They used actual financial stakes and created real, localized market bubbles within the experimental environment where the participants were trading against each other.
Oh, wow. So real money.
Real money, real consequences. The physiological responses they recorded were very real. And they found this glaring biological glitch involving the nucleus accumbens, or the NAC, which is the brain's reward center.
Which processes the expectation of financial gain, right?
Right. And what they found was that in the low-earning amateur traders, the NAC lit up disproportionately as the asset prices rose.
With a pinball machine.
Exactly. The bubble stimulated them so intensely that they were driven into the state of irrational exuberance. They were biologically compelled to aggressively buy at the very top of the bubble, just completely ignoring all rational indicators.
So they were basically high. High on the anticipation of profit. But what about the successful traders? Did they just, not feel the dopamine?
Their neurological profile was entirely different. Instead of being hijacked by the nucleus accumbens, the high-earning traders showed massive activation in the insular cortex, the insula.
Which is the center for processing risk and physical discomfort.
Precisely. The insula acts as an early warning system. In the Caltech studies, right before the market crashed, the high-earning traders actually registered physical discomfort, like actual pain.
Really?
Yeah. Their brains subconsciously detected the underlying instability in the market data, prompting them to sell their positions and get out while the prices were still rising, completely bypassing that greed impulse.
That is fascinating. Because the sources also detail another neurological flaw that pretty much every trader experiences, which is the disposition effect or realization utility. Basically, we are biologically wired to take quick profits and hold on to losses forever.
Right, and the mechanics of that are heavily tied to the ventromedial prefrontal cortex, the VMPFC. Instant you close a trade for a small profit, your brain releases a huge burst of dopamine in the VMPFC. It's this immediate, intoxicating reward.
But if you close a trade for a loss,
You suffer a sharp drop of activity in the ventral striatum, and the brain registers that as actual physical pain.
wait, so you're telling me that our evolutionary biology is demanding that we sell our winning trades incredibly early just to secure a quick dopamine hit, while simultaneously demanding we hold onto our losing trades indefinitely just to avoid the physical pain of realizing a loss.
Yes.
We are literally built to do the exact opposite of profitable trading.
You are fighting millions of years of evolution that was designed for survival on the savannah, not for geometric capital compounding. When highly intelligent professionals who, they're used to trusting their gut and relying on their intellect, when they step into the market without strict, rigid rules, their own neurobiology leads them straight to ruin.
They think they're making analytical decisions, but they're just chasing dopamine and fleeing pain.
Exactly.
Okay, so that raises the most obvious question. If our brains are actively working against us, how do the professionals survive? How do you build a defense against your own neurobiology?
Well, you have to build an external cage for your emotions. You need psychological and mathematical guardrails that completely remove your biological impulses from the equation. And according to the psychology sources we have, the foundation of this is the cognitive journal.
Okay, so professional traders don't just track their profit and loss, they track their cognitive state.
Mm-hmm.
Walk me through how they actually structure this, because it's based on cognitive behavioral therapy, right?
Yes, it is. It uses a 4-column framework to actively interrupt those destructive neural pathways. So column A is the activating event. Let's say you hesitated and missed a perfect order flow setup.
Okay.
Column B is your belief. What is your subconscious demanding in that moment? In this case, it might be, I missed my chance. I have to force a trade right now to make that money back.
Oh, the classic revenge trading impulse.
Exactly. Then column C is the consequence. If you follow that belief, you're going to take a subpar trade, ignore your rules, and lose capital. But column D, this is the crucial step. Column D is the constructive response.
So you actively rewrite the narrative.
Right. You actively write down a reframing of the event. Something like, missing a trade is a statistical certainty. The market will provide another high probability setup. My only job is to protect my capital until it does.
And by documenting this daily, you're training your brain to recognize the impulse before it becomes an action.
Exactly. You're building a new neural pathway.
I love that. Another guardrail that really recontextualized things for me was the concept of the daily profit target. I always assumed profit targets were just arbitrary financial goals.
Yeah.
I want to make $500 today. But the sources frame them as essential psychological armor.
Yeah, it's actually a mechanism for dopamine regulation. Without a hard stopping point, traders fall into what the sources call crack addict trading syndrome.
Wow.
Yeah, you hit a winning trade, you get the huge dopamine rush, and instead of walking away, your brain just demands another hit. So you keep pulling the lever, taking worse and worse setups, until you inevitably give all your profits back to the market.
But hitting a daily goal and physically turning off the screens, that just severs the dopamine loop entirely.
Yes, it protects your capital, sure, but more importantly, it protects your cognitive load. You don't spend the rest of the day in a state of hypervigilance and emotional burnout.
That makes a lot of sense.
But to fully cage the biology, you also have to implement mathematical discipline. The sources extensively cover position sizing, specifically the Kelly criterion. Have you looked much into that?
A bit, yeah. It's a scientific formula, right?
Yeah.
Developed at Bell Labs.
Right. It calculates the mathematically optimal percentage of your capital to risk on any single bet based on your historical win rate and your risk to reward ratio.
Let's actually break down how that works in practice, because this is where the engineers should excel, but they often fail because they ignore the math in favor of intuition.
Okay, let's say your historical win rate on a specific setup, like a stacked imbalance, is 50%. And when you win, you make twice as much as you lose when you're wrong. The Kelly formula takes those parameters and spits out an exact percentage of your account to risk to maximize growth without risking bankruptcy.
But the sources specifically warn against using the full Kelly calculation, don't they?
They do, yes. Because human probability estimates are inherently flawed and market conditions change, professionals use the fractional Kelly criterion, usually a half Kelly or even a quarter Kelly. So if the formula says you should risk 4% of your account, you only risk 1% or 2%.
Which completely removes emotion from the sizing of the trade.
Completely.
Like, even if your nucleus accumbens is just screaming at you to go all in because you feel incredibly confident about a setup, the math dictates the boundary. It mathematically eliminates the risk of gambler's ruin.
It takes the decision entirely out of your hands, which really leads to the final and perhaps most difficult mindset shift required for success. You must embrace being bored.
Embrace being bored.
Yes. Good trading is not an action movie. It's not an adrenaline rush. It is sitting in front of a screen, patiently waiting for the exact parameters of your system to align, and then executing the trade like a machine. If you are craving excitement, the market will gladly take your money to provide it. But if you want to compound capital, you have to learn to love boredom.
It's a complete inversion of how most people view the markets.
Truly.
I mean, we started today by discarding traditional, broken charts in favor of the granular telemetry of order flow and delta. We explore the mechanics of the market auction, learning how to spot institutional absorption, and those stacked imbalances that precede major moves.
Right, the real mechanics.
And then we strip down the neurobiology of the trader, revealing how our dopamine and pain centers naturally wire us for failure, which forces us to build cognitive journals and strict mathematical parameters just to survive our own biology.
It's a profound shift from viewing the market as a place of intuition, to viewing it as a place of rigid execution.
It really is. Yeah. We've talked extensively today about caging your own emotions, recognizing your own dopamine loops, and mathematically restricting your own biases. But here is something else for you to mull over as you stare at those screens. Order flow provides a real-time heat map of fear, greed, and panic. You are literally watching the biological flaws of millions of other human beings playing out tick by tick.
Yeah, you're watching their dopamine hits.
Exactly. But as artificial intelligence and algorithmic systems take over an increasingly massive share of the market's daily volume, those raw human panic cells and dopamine hits are slowly being engineered out of the tape. So the question you have to ask yourself is, if your edge relies on the market being a mirror of human emotion, what happens to your strategy when the trader on the other side of the screen is no longer human?